So today I have a very special guest on the channel. I have Adam Taggart from Thoughtful Money here, and I'm actually hanging out with him for the weekend up in Sebastopol, California. He came back into town just to see me and make this video. So I appreciate that, Adam. Nice to see you.
It's a pleasure to be here. Hey, everybody. We do this every year, Michael, usually down more like where you're staying, down closer to San Francisco. But yeah, it's fun to meet up my old stopping grounds here in Sebastopol, California.
Yeah, for sure. It's nice for me to come and do something different as well. So I'm going to hit you with the same thing you always hit everybody with. What
Okay.
is your current assessment of the global, or more likely the US economy, and how things are going right now?
Okay. And as I kick this off, I'll say, folks, I've yet to learn my lesson of filming a video outdoors in the wind with somebody who has much better hair than me. So my apologies for how crazy my hair is likely going to get here. So Michael, I'll say I am concerned in the near term about the economy. I think the economy is slowing. I don't necessarily predict that we're going to enter recession anytime immediately, but that's a possibility. I can't rule it out. I'd say I'm probably getting a little bit more optimistic midterm. I think that at some point in the next 6 to 12 months, the economy will start seeing some positive impacts from the business-friendly policies of the new administration. A lot of what President Trump is trying to do is a lot of pretty aggressive policies, launch a bunch of aggressive policies that are designed to really spur economic growth. And I think he's likely going to be successful in a fair amount of those. And then, long term, probably just as concerned as I've been, maybe even a little bit more so, when we talk about sort of the debt problems, the runaway fiscal deficits and stuff like that. So kind of in the short, in a nutshell, concerned, a little more optimistic, and then probably more as pessimistic as I've always been. In terms of, the near term, which I'm guessing most people care the most about, we are seeing continued signs here that economic growth is slowing. I think we're seeing a proliferation of signs that the consumer is really getting strapped.
Yes.
And we still remain about a 70% consumer spending driven economy. So as the consumer goes, so goes the overall economy. I think we're seeing signs that the job market is not quite as robust as the official data has been saying it is, even to the point recently where the president himself has basically said these numbers are baloney, and has fired the head of the BLS who's responsible for them. So I do worry that there will be continued weakness in the job market, and really that is, if you have concerns about recession, that is the metric to look at. So goes the employment market, so goes unemployment, so goes the economy. And if unemployment really starts rising seriously from here, then I think recession risks really become pretty valid. And the thing I'll note about that, which I think we've talked about in the past, is if you look at the historical pattern of the unemployment rate for the past 50 years, I mean, as long as I've been alive, it's pretty clear where unemployment rate, spikes going into recession, then it starts falling as the economy heals and the central planners do everything they can to try to intervene and get the economy back on track. It takes a long time to bottom. And once it does bottom, though, and starts going back up again, if you look at the historical pattern, once it starts rising, it actually accelerates and respikes, and then that's where you go back into the next recession. And if you look at the recent data, we have clearly bottomed. The unemployment rate is starting to come back up. It's not at very worrisome levels yet, but if you look at the trajectory is a little bit worrisome at this time. And we're starting to begin to see data like continuing claims, which had been fairly flat for a good while. They're really starting to pick back up now. So it just feels like we're on the cusp where the unemployment rate could start running away from us. Is it going to? Who knows? We'll be watching closely from here. But we do seem to be right at that point where, if you look at the historic pattern, things really start to pick up speed for the worse. So I'm going to be watching that really closely.
Now, that's a good point that you made with unemployment and always having the recession once unemployment kind of bottoms out. However, you know, I do a lot of different digging and research on my channel as well, and look at a lot of different economic trends. And here's a couple of things I want to point out. I don't know if you know this or not, but right now, functional unemployment is at 24%. And functional unemployment is anybody who's been out of work for 6 months or longer. They don't make a living wage, so they're living in poverty wages, or they've not been counted in the unemployment numbers for over a year because they've stopped looking for work. And so that is obviously a lot higher than the official 4.2% number.
You're absolutely
that
right.
the government gives us, right?
Yep.
And then we recently had the CPI reading come out, which has also been going back up. And we see in there that there's a lot of things that are kind of missing. Like, for an example, one thing that was sent to me by one of my viewers is the way that they calculate homeowners insurance is not even in the CPI. So different things that they do to kind of finagle the data in a way that it almost feels like we can't even have another official recession ever again, just because of the way that they calculate the numbers, the way that the unemployment is calculated, the way the CPI is calculated. I feel like they've honed it in so well that the data will never reflect that we're in a recession again, regardless of what happens with the consumer.
Yeah.
What do you think about that?
I certainly get your point, and yes, and most of your viewers probably know this, but once you have not been looking for work for a certain period of time, and I can't remember what it is off the top of my head, but the government considers you as no longer in the potentially employable labor force, it's almost like you just don't exist anymore.
Right.
They take you out of the calculation. So to your point, if you just look at the unemployment rate and say, oh, things aren't that bad because, you know, only 4.2% of people don't have jobs, that's not true at all.
Right.
It's 4.2% of the people who are actively looking for work have not found employment yet, right? All the other people who have kind of aged out of the potential calculation just aren't counted anymore. And it's something like, I think we talked about this in one of our previous conversations. There's over 100 million US adults who are not included in the calculation for unemployment, right? I mean, it's basically a third of the country.
Right.
Right. So to your point, yeah, I think a lot of people for a while now have been looking at the official calculations and saying like, hey, this doesn't really seem to match reality, right? And
Exactly.
the CPI is a great example, right? It is a heavily distorted number, right? It's distorted not just through what they count and what they don't count, but also through things like hedonics, which are sort of fancy ways of trying to justify why prices haven't gone up, even though they really have.
Yeah.
And this is just sort of creep after every presidential administration. There's just been, each administration has done what it can to try to burnish the numbers and make them look a little bit better. And then over time, it just gets incredibly distorted. So I agree with you. I don't think they are so far gone that we will never have an official recession again.
Okay.
I think if the official unemployment rate gets up above 5 and certainly gets above 6, it's going to be undeniable. And I think that's going to be undeniable both in terms of the official numbers like the GDP number, and I think it's also going to be undeniable in the sense that like just so many people are going to be out of work that they're going to look around and say, I don't care what these numbers say, like we're in a recession.
Sometimes I think we're already at that point right now. I think a lot of people look at things like that already because we've had already over 800,000 jobs lost since the beginning of 2025. We just had that big downward revision a few days ago where we had 258,000 jobs, I think, less than what they said there was over the past couple of months between May and June. So I feel like a lot of people are already there, right? A lot of people are looking around and saying, hey, I already lost my job. It's much harder to find a job now than it was 2 or 3 years ago. And regardless of what these numbers say, I'm hurting.
So I don't disagree with you, and I follow this fairly closely too. And we've had, I think, more bankruptcies this year than we've had in a long stretch of years, right? So there's a lot we can point to say that the labor market isn't as strong as the official numbers have been saying. That said, we aren't seeing job shedding at the rate that we normally do, kind of entering into a real recession, you know, where you're seeing like hundreds of thousands of jobs lost a year. We're still seeing positive job growth every month. It may not be, that number's been coming down, so it's not as strong as it was, say, like a year ago. Also, we can call some of that into question. So maybe it's not quite as strong as the exact numbers say.
Right.
I don't think it's necessarily negative yet, though. And part of that is, you know, what happened during COVID is companies fired a ton of people as we shut down the economy, right? Mm-hmm. And then we started putting, you know, trillions of stimulus into the economy, and companies realized, oh, okay, well, whoa, I need to hire all these people back. And they had a really hard time doing so. And you had a bunch of people who retired early during that time period because that stimulus juiced the markets and their retirement funds did better than they were initially forecasting. You had another bunch of people who now were getting multiple job offers from desperate employers. They were also getting checks in the mail. And so they had a lot of bargaining power for the first time in a while. So the employers sort of have the PTSD of a couple years ago still at the forefront of their mind. And so they have been loath to fire. Now they have, a lot of them implemented hiring freezes. I'm not saying that firing hasn't been going on, but it's largely been like letting people go through attrition or select layoffs of different departments and stuff like that.
Voluntary buyouts too.
Voluntary buyouts and stuff, yeah. And you've heard the term labor hoarding, right?
Yeah.
So in parts of the economy, particularly in technology, you've had labor hoarding where companies, you know, in some cases have hired people not because they actually have an immediate use for that worker. They just don't want that worker going to their competition, right? I don't think they're actively hiring many people right now to try to kind of prevent them from going to the competition, but I don't think they have just decided, all right, we're going to get rid of all those people yet. I think we are going to get there for two reasons. One, like I said, I think the economy is slowing. Eventually that's going to start pinching the profit margins of these companies. And, you know, they're eventually going to get into the existential position of, hey, look, I got to cut costs. I finally got to get rid of these people that just aren't, you know, really, I can't really justify to keep around.
Yeah.
Secondly, you're going to have presumably the benefits of AI, right? Where these companies are going to say, hey, look, I made these big investments in AI. I didn't really want to fire my workers yet until I was really sure the AI was going to pay off. Mm-hmm. But now that I'm beginning to see that it will, okay, now I can start getting rid of these people, right?
Yes.
So I think there's kind of that double whammy ahead of us here. And, you know, we're already hearing this happening at certain companies. There have been some stories in the media recently about like teams of AI developers that were hired to build AI tools. Once they build them and tested them and the company realized that these tools were valuable, they then fired all the developers they hired to build them, right?
Isn't that ironic?
Yeah, so that's starting. So just to get back to the main point, I think the brunt, like the shoe to drop on the employment side, where we say, hey, look, I look around and I'm seeing lots of unemployed people and my friends are losing their jobs. Maybe I've even lost my job. I don't think we're there yet at scale. I do think the probability, in my opinion, is uncomfortably high that it's coming. I can't tell you if it's coming in a quarter or two or in a year from now, but I do think that that's ahead of us. Now, the one thing that I think on the bright side is, I mentioned earlier that the new administration's policies are going to start bearing fruit at some point in time. We have, you know, the reshoring of American jobs. We have the tariffs where Trump is basically saying, hey, look, if you don't want to get tariffed, you build your products here in America. You know, if you're in South Korea, you know, you build, I don't know, whatever, you know, cars, widgets, whatever. Open factories in America, hire American workers to build them, and then your products won't get tariffed. The whole drill baby drill, mine baby mine, initiatives that the administration's now pushing, that is going to actually create a whole bunch of jobs. So that will, to a certain extent, be a cavalry that's riding to the rescue. The question is in what time frame?
Right.
I don't think we'll see a ton of that in the next year, but maybe starting in about 12 months, it'll be ramping up from there. And now, if you lose your desk job, at a corporation, does that mean you're going to easily be able to get a job, as a welder on an oil rig? Like, I don't know how directly transferable some of these skills are going to be.
Yeah.
But I think over time, people will be able to transition and reskill. So I don't necessarily think that this cavalry is coming, like I said, in the next 6 months or so, but maybe in a year and a half, we will hopefully be able to absorb a fair amount of the people who do get displaced by these trends that we're talking about. But I can see, back to my sort of original point, I can see a period over the next 12 months where we start seeing that job shedding. We start really feeling like either the economy enters recession, or it just starts to feel more like one to more of the of society, because more and more people are losing their jobs. And so, yeah, the next year or so could be pretty bumpy, but hopefully, like I said, the cavalry will start riding to the rescue here.
So since you brought up the tariffs, I want to ask you something else about that. The tariffs are in place right now because Trump is in office, but they could easily be removed if the next president comes in and says, hey, we don't want these tariffs anymore, or whatever.
Yep.
So what would be the incentive for a company to spend millions, if not billions of dollars setting up, shop here in the United States, if the tariffs could go away as easily as they just got put on right now? That's one of the biggest arguments I've heard against the tariffs, as far as, why would the company invest all their time and resources into something that might not even exist in a couple of years? And of course, if you're going to set up manufacturing or a facility, it can take years just for it to be completed.
It's a fair question, and I should say I'm not a geopolitical expert, so take my opinion with a grain of salt, but I do talk to a lot of people who are smarter in the space than I. And my general point of view on that is 3.5 years is a long time. It's not nothing. And at the end of the day, these companies, they need to make money. They care about the bottom line, and they care about the bottom line next year, the year after, the year after that. I don't know if they could just sit out and just eat these tariffs in full force for 4 years.
Right.
Secondly,
but the problem is they probably won't. They'll pass on the cost to the consumer. That's what they typically.
Well, it depends, right? Do you want to keep your market share? Because if your competitors are building their let's use cars as an example. If your competitors are building their cars in the U.S. and their cars are now cheaper than yours, they're going to gain market share at your expense, likely, right?
Great
so, so you got to first figure out whether you've got the wherewithal just to eat those tariffs for another 3.5 years. Secondly, we could have President Vance in 4 years, right? So you could have sat and ate it for 3.5 years, and then realized, oh my God, this same regime is going to be in for at least the next 4 years, if not 8, right? And then all we have to do too is just look back at what happened after Trump left and Trump 1.0. What happened to the tariffs? The Biden administration, which had an extremely different, world view than the Trump administration, largely kept them in. Right. So I think it's kind of a dangerous risk to just bet that in 3.5 years there's going to be someone different in office who's going to get rid of the tariffs.
Okay, I'm glad you brought that up. So last time we did a video, I think it was about July or August last year. It was about a year ago.
About a year ago. It was another really hot day like this, yeah.
It was. But we did another video about a year ago, and last September was when the Fed actually started their rate cutting campaign, and mortgage rates actually started going up after the Fed started cutting rates, which was pretty a big surprise for a lot of people. Most people were expecting mortgage rates to go down. And in fact, they're just as high now, if not higher, than they were before the rate cuts ever happened. And, I want to talk about that a little bit, because a lot of people think that when the Fed's going to come in and cut rates, because now there's a lot of speculation that now that we had this bad jobs report, that they're going to come in September and start cutting rates again. Why, after going through everything that we've just seen over the past year, do you think people are still believing that the mortgage rates are going to come down from the Fed rate cuts, and somehow that's going to fix things in the
Sure.
economy. Why do you think they still have that mindset?
Well, okay. First, I think they have that mindset because that's what they're being told. And, if you are listening to realtors, they've been selling you this for the past couple of years, right? It was survive until 25, right? Hang in there until the Fed will eventually bring rates down, and then mortgage rates will come down, right? And to your point, a lot of people got their mind blown last September when the Fed came in with a 50-point rate cut, and then long-term interest rates and mortgage rates actually crept up, right? So first off, it's just what they're being told. Secondly, that is sort of the general, that has been the general correlation between the Fed interest rates and the 10-year Treasury and mortgage rates. Is generally, if the Fed has been hiking or cutting, the longer rates have sort of followed suit. Now, what's different this time, the reason why they didn't, right, is inflation. So when the Fed cut last time around, interest rates, I'm doing this from memory, but I think the CPI was at least had a 3 handle on it, right? So it wasn't close yet to the Fed's 2.0% target rate. And I think the market was, the bond market was a little skeptical, right? That the Fed didn't have inflation fully under control. And so I think it interpreted the Fed's cutting, in my opinion here, as a political maneuver to try to help the existing administration, right? And they said, look, I don't care what you're doing in the immediate term, political or not, I care about inflation. You don't have inflation under control yet, but you're starting to cut. And so they said, look, that makes me uncomfortable. I want to get compensated for that additional risk, and so I'm going to start pushing the longer end of the bond curve up, and that's what brought mortgage rates up along with it. Will that happen this time around? I think, it's up for debate. I think there's half the people who think, look, the CPI has a 2 handle on it now. It's not 2.0.
It's 2.7%.
Right, 2.7%, but close enough for now. The economy's slowing. That's going to bring down inflation. It's going to bring down demand over time. Not that worried about inflation anymore. The bond market shouldn't be that worried about inflation anymore. Now, there's a counter argument to that, which is, hey, look, the tariffs have been implemented. Yes, they haven't had that much of an inflationary impact yet on prices, but that might be coming. And if the Fed starts cutting right as we start seeing the impact of tariffs, that again could be what the bond market doesn't want to see, right? Which is you're cutting right when prices are going up. I don't know if I've got a strong opinion one way or the other on this. I think it really does depend on how much the economy cools from here. I also don't think that tariffs are as inflationary as a lot of people are told that they might be. I don't deny that they can push prices up, but it's more of a one-time price shock.
Right.
And as we talked about, there's a lot of countries and companies that are going to try to, work their way around these tariffs, right? They're either going to find ways to produce in the U.S. and avoid the tariff altogether, or they're going to, help eat the cost of the tariffs. And so the actual end impact to the consumer, not saying it'll be zero, but I think it'll be less than what some folks are fearing. And again, I think it'll be more one-time in nature, right? My personal opinion here. But, when the Fed cuts from here, does the long end of the bond market and the mortgage rate go up or down? I think you can kind of almost argue both ways at this point in time. I personally think that the odds are rates will trend lower over the next year. Let me put it this way. I'm not too worried right now about mortgage rates going substantially higher than they are for a prolonged period of time.
Do you have any concerns about inflation rebounding? Because the latest inflation report we have actually is all up. The CPI went up to 2.7%, I think from 2.6.
Yeah.
And the core inflation went from 2.9 to 3.1, which is what the Fed actually looks at more than the CPI. And my concern personally is if they start cutting in September, then that number is just going to continue going up. And there's a 90% chance by the betting markets right now that they believe the Fed will start cutting rates in September once again. And, the last meeting, There was only 2 dissenting members. Everybody else said no rate cuts. What do you think they're going to do this time around? And do you think that they should cut rates?
Uh, I'll be a little controversial here and say probably. So to me, I think what matters more in the end of the day here is where the strength of the economy and where it's headed. I think you really only have to worry about inflation here if Fed cuts goose the economy and the economy starts, kind of overheating. And I don't see that being the danger here. I think the risks are more towards the economy cooling more than we'd like to see here. And I can give you a couple examples of why I'm concerned about that. And I think, I'm not too worried about the rise from 2.6 to 2.7 in the headline CPI. Some of that's just base effects, which is just the year-over-year math and where certain things are going. What's really going to push the CPI around up or down is going to be what happens with housing. Shelter is such a big component in the CPI, and it's been a lagging one. It's one that's been taking a while to correct. It took a while to start coming down. And if I look at the housing market, most of the trends I see there are still for lower prices ahead on average. And so I think that the shelter component of CPI is going to act as a weight. And like I said, I think it's like 40% of the CPI. So if that is deflating, that's going to keep inflation from or the CPI from rising material, and probably will bring it down over time. And here's one thing that's related to housing, but it's related to the economy in general that's really got my attention, which is, you remember during COVID, the central planners did an awful lot to ride to the rescue, right? Pumped trillions in the economy, and they had a lot of loan moratoria, right? So you didn't have to pay your mortgage. You didn't have to pay your student loans, all sorts of loans you didn't have to pay, right?
Yes.
And they were giving people money, right? Which they were using to pay down debt. So the excess savings that people built up over COVID and were using to pay down debt, that's long been spent, right? And we've seen we saw that debt balances were coming down for a while, and then they've shot back up to record highs, right? And that debt is now at record interest rates too. So not only do we have more outstanding consumer debt than we've ever had, but it's never been as expensive as it is right now. That puts a weight on consumer spending, right? But as those loans have gone back into repayment, people have had less money left over to spend on other things. And they've been putting it on the plastic, although we're seeing signs now that people aren't able to borrow anymore, that they've kind of maxed out their borrowing ability.
Yes.
But the last loans to go into repayment were student loans. And I think that's actually a potential game changer here for a couple reasons. First, a lot of student lenders, I think there's like 60 million in total, a lot of them believed what the previous administration was telling them, which is, hey, you're not going to have to pay this stuff back ever, right? We're going to try to forgive your loans, right? And so a lot of people just eventually mentally took the money they would have been spending on their student loans and used it to fund their lifestyle, right? So all of a sudden they're now being told, now you got to start actually paying those loans back. And they're like, well, look, I've expanded my cost base. I don't really have that money lying around anymore. Well, now they got to find it. And you've got to pay your student loans. It's the one form of consumer debt that you can't discharge in bankruptcy, right?
Yes.
And also, if you don't pay it, the government can garnish your wages. So they're going to get it one way or the other from you, right? So now you're like, okay, I got to come up with a scratch to pay my student loan. And what we're seeing is that they're, and oftentimes robbing from Peter to pay Paul, where they're like, okay, I'm going to be light on my auto loan payment this month, or I'm going to be light on my mortgage payment this month, right? So when you look at the recent delinquency data on consumer debt, you can see student loan debt went from basically 0 delinquencies over the past couple of years because they didn't have to repay it, right? It's now like doing a moonshot,
Yes.
right? And we are seeing a similar but less dramatic effect in the other forms of consumer credit. So delinquency rates are now coming up on on credit card debt, on auto loans, even on mortgages, right? So I think that trend is only going to continue to build from here as those delinquencies then become defaults. So, essentially we have the risk of a cascading credit contagion here, where people's inability to service their student loan debt starts infecting their ability to pay back these other types of debt. And, you start seeing losses in the lending industry as a result of this. And that's really what creates big problems. Like 2008 was a credit crisis at the end of the day. I don't know if this is going to be as big, but I can see this as being a similar type of credit contagion where the banks start taking losses that they didn't expect that they were going to take, and that begins to become a problem. And when that happens, banks stop lending or they tighten their lending standards, right? So not only are they challenged to meet their debt payments anyways, but they're challenged to go out and borrow to fund the other things that they need to do in their lives. And as I said earlier, we're a 70% consumer spending driven economy. All of that shrinks consumer spending, right? So that shrinks GDP. That's what potentially sends you into recession. So I'm actually quite nervous about this. And I first heard about this as a warning flag from Anna Wong, who's the chief economist from Bloomberg Economics. And, she explained what I just explained to you here, but she also noted that the lending industry has not, at least when I talked to her about this, which was probably like 2-3 months ago, she was like, they're still not that worried, or they weren't that worried back then, because they were saying to themselves, well, right before 2008, consumer credit scores were lower than where they are right now. So the consumer credit worthiness isn't as bad as it was heading into the great financial crisis. But Anna says, well, not really. Just like in academia, where there's been grade inflation over the past couple of decades, it's easier to get an A than it used to be. Mm-hmm. She said a similar thing has happened with credit scores. So if you kind of discount today's credit scores back to their actual, historic number, it's actually about the same as where we were heading into 2008. So what she's saying is that the banks are likely, as these delinquencies and defaults start coming in, they're likely going to have it forced upon them that, oh, you know what? These people aren't as credit worthy as we thought. And so therefore, we're going to have to start tightening our lending standards. We're going to have to start increasing the interest rates that we charge on debt. And that's going to have that chilling effect on economic spending that I was just mentioning earlier.
Yeah, and actually to your point, Adam, I literally just did a video a couple days ago about household debt, which is now sitting at a record high, a new record high of $152,000 on average. And about 2/3 of that debt is mortgage debt.
Okay.
But the other third of it is made up of student loans and auto loans and credit card debt for the most part. And in nominal terms, it's actually worse than it's ever been. If you adjust it for inflation, it's slightly below where it was in 2008. But that's yet another indicator that people are maxed out on their borrowing capacity. And also in 2008, it was much easier to get a mortgage. So that mortgage debt accounted for an even larger portion of the household debt.
Good point.
Back in 2008 than it does now. So, and people need debt to buy everything these days. You see people using buy now, pay later just to buy groceries, or just to be able to finance the coolest thing they see on TikTok for the clothes or whatever, So if it's already getting to that point where people need to leverage debt to buy everyday things, it definitely makes me concerned about where things are going to go in the future, especially since our economy revolves so heavily around spending, because people should stop spending. People need to stop spending in a way in order to save themselves, don't they? I mean, if you're that hard up for money, you have $152K in debt, I think it's probably time to turn the spending off.
Well, look, I'm right there with you. And I think that is a chilling sign that you brought up, which is that people are using these, kind of layaway programs like buy now, pay later to fund life essentials like groceries, right? Look, humans are creative and, desperate people will act desperately. So as long as you give them access to some type of credit when they're in distress, they will use it, right?
Yeah.
But just like 2008 was an example of us giving far too much credit to people who really shouldn't be taking it on. And then we all, when the piper needed to be paid, we all paid for it.
Yep.
I think buy now, pay later is a great example of that. We may be at a very similar state today, maybe even worse, right?
That didn't exist back in 2008. We didn't have buy now, pay later.
Exactly. And buy now, pay later is just, it's one of those nefarious things in my mind because it preys upon the folks that can least afford to absorb the losses, right? So, no, I totally agree with you. And you know, what's interesting is I know we talked about this the last time we talked, which is the difference between averages and medians, or means and medians, right? Where if you looked kind of on at the average economic numbers for much of the past couple of years, things looked okay, and they even still do today to a certain extent, right? And it's not for nothing too that week we're talking, stock market hit an all-time new high, right? So the bulls can definitely point to stats and say, hey, look, what are you guys talking about? Like, everything looks fine, right?
Right.
And I think a lot of the reasons why they kind of look fine on the surface is because of the averages, right? The very wealthy, they punch far above their weight in terms of consumer spending. And, they have done relatively fine, right? And certainly with the stock market having bounced back over the past couple of months to all-time highs, they're feeling pretty flush. They're still able to spend a fair amount. So they're able to pull the average up in terms of, overall retail sales, things like that, right? But even with that, we can see that the bottom 80% are continuing to struggle and fall further and further behind, right? And you probably heard this term K-shaped economy.
Yes.
Right. The top of the K is the top 20% that's doing just fine. Bottom percent is the bottom 80% of the K. I think that that's very much the world we're in here. And my big concern is that this isn't something that's going to be episodic. Like, it's just a business cycle, and then on the next up cycle, everybody's going to be doing great, right? And we're going to get rid of the K, and it's going to be more like a traditional, the economy the way that it used to be back in previous generations. I'm actually more concerned not only that the K-shaped economy is here to stay, but that we're kind of headed. Yeah, it'll intensify, where the advantages continue to concentrate in the pockets of a smaller and smaller few. And that these are the people who own, more and more of the assets. And we're already kind of there. Like, in terms of financial assets, like stocks and bonds, the top 10%, the top 10% of households own 93% of the financial assets.
That's crazy.
Right? It's just crazy. So in my mind, I'm afraid that we're going to enter into what I call an I-shaped economy. So, the lowercase I is a little dot separate from everybody else. That's the top elite. And then everybody else is that long line heading downwards, right?
Wow.
And just one last point on that is, we're even beginning to see some cooling off in the top of the K right now in terms of its spending. And that's one of the things that concerns me here in the near term, which is, we're seeing a lot of luxury brands that are seeing, slowing sales or poor stock performance in some of these companies. And not that I wouldn't like to see the wealth gap in society close a bit, but if that upper 20% that's really been keeping the averages high starts tightening its belt, that's going to have an outsized impact on consumer spending, and that's really going to slow the economy too. So, like I said, we're starting to see some initial signs of some trouble there, and if that continues, then yeah, I think we should be pretty concerned about where the economy is going to go in the near term.
Yeah, and that kind of circles me back to the point I was making earlier, which is that if the data can never really truly reflect a recession in the future, like, because all the stock market looks at is what's the recent jobs report doing? What's the CPI report doing? Is the Fed going to cut rates or not? Those are like the three top things that influence where the stock market goes. And if those things never really show a negative reading, or even when they do with the jobs revision, it's like, who cares? Stock market goes up, everything goes fine, new record highs. And if you have, the top 10% of people owning 93% of that wealth, then theoretically this kind of game show can go on forever under those circumstances.
Yeah. And I understand that sentiment and how sometimes it feels that way, like it'll never change. And look, everybody, I could be wrong here. Maybe things are totally different this time. But from the folks that I interview on a weekly basis, they are increasingly saying, this is starting to really feel like the dot-com bubble, or starting to feel like kind of late 2021, which is just nothing seemed to dent the market's exuberance. bad news was good news because it meant that the Fed was going to intervene and cut rates, right? And good news is good news, right? So just anything is good news.
Right.
Any potential worries that are out there, you know, and the tariffs is a great example, right? They freaked the market out when Trump came out on Liberation Day with his big poster board because the numbers on that board were bigger than what everybody was expecting. But pretty quickly, people realized, oh, you know what? He's using those big numbers as a stick. The actual tariffs aren't going to be that large. And then secondly, they just kind of got to the point of like, you know, we're not going to worry about tariffs anymore. And, you know, whenever you see news now about tariffs or trade deals, good, bad, whatever, market doesn't care, right? And so the levels of speculation that we have in the market right now are getting to be extremely high again. So SPACs, which some of your viewers might be familiar with, a highly speculative vehicle that we saw initially during the COVID craze when the money was pouring in and investors just couldn't buy, you know, anything fast enough. A SPAC essentially is a shell of a company that says, I don't know what I'm going to use this company for yet, but give me your money and I'll figure it out, right? Sounds terrible, but SPACs are back. The meme stocks craze is on fire again. Cryptos, you know, a super risk on asset, they're on fire again. So we're seeing a lot of the like bulletproof exuberance that we've seen at previous cycle highs. Now, these cycle highs can last a lot longer than you can imagine. So I don't want to give anyone the impression that, you know, hey, this is all ending tomorrow and rush out and sell everything you got. But the market veterans that I interview, you know, definitely say, hey, look, things are stretched in some cases to stupid levels at this point, especially forward earnings estimates. I don't know any analysts I interview who think we're actually going to grow into next year's earnings estimates. They just seem too unrealistically high at this point. But right now the market doesn't care. And, you know, they're saying, look, it can not matter for longer than you think, but ultimately something will happen that will force Wall Street to have to redo its math. And, again, I'm not saying this is going to end in a massive stock market crash or this is going to end in a 2008 style, you know, crisis, but I do not think they have gotten to the point of intervention where they can prevent winter from arriving. You know, there's seasons to markets in the business cycle. And I do think that in the next 12 months, I'd be shocked if we didn't have at least a normal market correction, like another sort of 10, 15% correction. Could be worse, but might not be. And, you know, 10 to 15% hurts when you're going through it, but it's really not that big a deal, historic wise. And it would not surprise me if we went through a kind of garden variety recession, you know, maybe 2, maybe 3 quarters of negative GDP growth. Again, not necessarily like 2008, where, you know, you're getting millions of people shoved out of work in a very short period of time. But, you know, maybe half a year, 3 quarters of a year that, you know, a fair amount of people lose their jobs and it just feels slow and sluggish. But then on the tail end of that, you know, the economy starts growing again, boosted in probably no small part by these new policies by the government. So, I understand your frustration of like, Jesus, will it ever matter at some point?
Right.
And I guess I'm just saying, you know, I don't think we're at the point yet where they have been able to permanently dispel the natural business cycle.
All right, here's a viewer question from Cameron Jenkins.
Great.
Cameron Jenkins.
Hit me, Cameron.
Okay. He says if Jerome Powell submits to political pressure from the White House and lowers the federal funds rate, will the bond market do the work for him? In particular, will the 10-year stay the same or go higher?
Okay. God, I hate to say, Cameron, I don't know for sure what's going to happen here. So if Powell cuts, which the market expects him to do right now, honestly, I don't really expect too much to happen. The market, last time I checked, I think it was a 98% probability of a quarter point cut in September. And while the rate wasn't as high for October and December, it was still a majority that the market was still expecting, you know, 2 additional rate cuts after September this year. So I think the bond market has kind of already priced that in, to be honest. I I think the question, and maybe the better question is what will the bond market do if the Fed surprises in September? And by surprising, it would either be by not cutting, right? Or it would be by cutting, say, by 50 basis points. And let's take the latter first. Let's say the Fed cut by 50 basis points. I think that would catch the market by surprise because the market's not expecting that. And I think the market might say, whoa, the Fed's worried about something here.
Right.
Right. And then the question becomes, okay, do you get a safety trade where people start buying treasuries, which would bring the 10-year yield down? Or would people say, oh, this means the system's more unstable than I thought, and they would, demand that a higher compensation for that? To be honest, I think if the Fed surprised that way, I think that that the 10-year would go down. I think the safety trade would kick in there. Now, if the Fed's surprised by not cutting, I could see bond yields going up a little bit as a result of that, because they would say, oh, you know what? I think the Fed's more concerned about inflation than they were letting on. And as a bond investor, that's what I care the most about, is what the future inflation rate's going to be. And if the Fed thinks it's going to be higher for longer, I need 10-year yields to be higher for longer.
Which also means mortgage rates are going to be higher for longer.
Which also means mortgage rates would then be higher for longer as well, too. Yeah. And to the spirit of the question, if the Fed does cut, let's say by 25, what'll happen with mortgage rates? Like I said, I think that's already largely priced in, so probably not a hell of a lot. By the way, I'm looking at my shirt and seeing I'm just sweating all the way through here, so sorry for that, folks. It's hot out here today.
Yeah, it is. Although it's still not as hot as Florida.
I was going to say, for Michael, this is like a chilly day, Florida-wise, in summer. For Sebastopol this time of year, this is pretty hot.
It is a lot hotter than Tiburon, though, I'll tell you that, because I think it was only going to be a high of 75 there, and it's like 87 here, so it's a pretty big difference.
Yeah, and I'll tell you here, normally, we get some marine layer coming in, so it doesn't usually get that hot here. So this is kind of a rare day.
Okay.
It's still a pretty day, but it's hot.
Well, I'm a Florida boy. I can deal with it.
I'm just not sure I can do it.
Okay, here's another question from Leslie. Ask Adam about the combined effects of high HOA fees, high condo assessments, high insurance fees, high property taxes that substantially add to the monthly cost of homeownership. People argue about high mortgage rates versus high prices, but the additional cost of homeownership is not declining and it's not going away. So What is your take on that?
This is why I'm as confident as I was earlier that I think shelter costs are going to be coming down. Look, the long and short of it is that the cost of homeownership has gone up, right? Total cost of homeownership.
Absolutely.
Mortgage rates have gone up, but as she just mentioned, the knock-on effects of everything else, property taxes, insurance, maintenance, et cetera, right? So mathematically, that needs to, long-term be reflected in the price of the shelter. We have this very bifurcated economy in general, but it's certainly very true in the real estate market. And I think the thing that's probably most important in sort of forcing true price discovery in markets is inventory, right? Inventory has been historically low nationwide for the past bunch of years. We had an artificial surge in demand during COVID, right? As people, basically were given a lot of money, both directly as well as, they saw their financial assets get goosed by all the stimulus we talked about earlier. So you had a lot of additional buying in COVID that either wasn't going to happen at all or was going to happen a few years out, but got pulled in to the COVID years as people had fear of missing out or fear of getting priced out, right?
Yes.
So a lot of millennials who were probably going to buy a house in the next 2 to 4 years who decided we better buy now before we get priced out, right? So we pulled all that demand forward. And now we're starting to see the repercussions of that in an increasing number of markets. Not all, but an increasing number. So in Florida, where you live, you're definitely seeing this. Texas, parts of California, we're now seeing it, especially down in places like Palm Desert, where there was also a huge influx of buyers from the whole short-term rental craze,
Yes.
right, which is now cooling. So, in those markets, you're seeing, very substantial price declines, right? So to the spirit of her question, Cost of homeownership goes up, cost of the home needs to come down. If you doubt that's going to happen, look in those markets I just mentioned. It has already happened. I think it is increasingly entering more and more states, more and more real estate markets, but not until the inventory gets back into historic balance or starts creeping above historic means, which again, we're seeing in more and more markets now. So, you might be sitting there in the Midwest and say, what, I'm not seeing this anywhere. And yeah, you might not for a good while, maybe not for the next bunch of years if inventory remains real tight in your market. But once inventory actually starts getting back to historic means, you're going to start seeing that true price discovery kick in.
Yeah, and to give you an example of whatever you just said, Adam, like right here in your old hometown, right in the Santa Rosa metro area, 1 year ago when we talked, home prices here were actually up 3% year over year. Well, fast forward to today, they're now down 2.2% year over year. The for sale inventory here is also higher than it was before the pandemic at about almost 1,400 homes for sale. Pre-pandemic highs were about 1,200 homes for sale. You also have about 27% of homes on the market in this area with a price cut. And the days on market are higher than they were before the pandemic at about 57 days on market. So that's how much things can change in just 1 year. And that's a good point because, especially up here, people were saying this was never going to happen.
I was going to say, up until a year ago, people thought those stats would never be possible.
Right, exactly. And now it's happening in even the most unsuspecting places in the Bay Area where people supposedly have, an endless amount of cash. Well, why is this happening then,
So great point, and let me just be transparent with your audience here about why I actually don't live here anymore, which might be news to some of your viewers. So I've lived in this area, this town, for 13 years or so. And I've got a lot of reasons to be living here. A very big one is family. My wife's family lives locally, and that's, the one thing you can't recreate elsewhere. And look, there's a lot of natural beauty here. It's a wonderful place to live, despite being located inside the state of California. But when my wife and I sat down and paid our taxes this spring, we looked at the number and we said, wait a minute. There's a lot of reasons for us to pay the California tax, the California premium to live here. But is it worth this amount? And we looked at each other straight in the eye and said, we can't justify this. And that's just the state tax. Now, of course, the cost of living here is a lot higher than a lot of other places as well. The real estate here is crazily priced, as you know. And so once we sort of made that decision of like, look, it's just not worth it for us anymore, we started looking around, the attractive math of the alternatives all of a sudden became really compelling. And so what's nice about where we live here is the state next to us, Nevada, is a 0% state income tax state. And so, it's still within driving distance to here. So within 4 hours, we can be back and spending time with my wife's family, if we want to come visit for a weekend like this one. But just jumping that border, saves us minimum 13% of our annual income, which, is at this point is fortunately substantial enough to really matter. So, even I myself, relatively successful entrepreneur, I've been pushed out of the state, and I'm just an example, and probably a small example, of the millions of successful but mobile professionals who have pulled up stakes and moved to some place where they're being treated better economically than the state. So, I think we're getting to a point where the reality of the economics is actually changing what's happening on the ground, where people are hitting their breaking points and, either moving out of expensive areas like this for cheaper places in California, or guys like me who are just finding, different states to go relocate to.
Yeah, and I'm glad you brought that up because this is our third year in a row doing this walk and talk. And the last 2 times I asked you about that, like what keeps you here? And obviously family was the biggest one. But as far as the financials go, it's just coming to the point where sometimes it just doesn't make any sense anymore. And I feel like places like California, because I ask everybody who I meet who lives here in California that same question, and everybody has a different answer. But it seems like eventually, if you end up paying enough, people do get to their breaking point and say that doesn't really make sense to be here anymore.
Yeah, there's this is going to be a little crass, but there's an exercise you can do with people where you say, "Hey, Michael, there's a mosquito on your arm. If I offer you $1 to swat it, would you?" And you're like, "Yeah, of course I would, right?" I say, "Okay, well, what if it was a beautiful butterfly?" And you'd say, "Oh, no way would I do that for $1." Well, how about for $10? No, no way. It's a beautiful, right? It's a beautiful animal. But if I say, okay, well, what if I give you $10,000? What if I give you $100,000? There's some point at which you're like, okay, I'm squashing that butterfly.
Yes.
Right? And it's not dissimilar from what we're talking about here, where you're like, look, I've got all these things that are keeping me here, and yeah, it's inconvenient, it's pricey, but this is important to me or whatever. But once it crosses your own personal threshold where you're just like, wait a minute, I care about this, but not that much.
Yep.
It changes your total perspective. And you asked me a question before we started the hike, which is, hey, have you done the math of, given how long you've lived here, if you had just lived in Nevada the whole time, what would you have saved? My brain doesn't even want to do that calculation because I'm afraid of how big the number is going to be.
Especially if you do the compounded interest version of it, if it was invested the whole time.
Exactly.
Okay, so this is kind of like a combined viewer question. First of all, one person asks, is AI really taking tech jobs, or are companies using it as a convenient reason to reduce their workforce? And also, kind of leading into that, is what do you think about the AI companies and these big AI CEOs and pioneers introducing the idea of universal basic income as our future, because AI is just going to do everything?
Okay, great questions. I do think the productivity boom that we're being sold, the potential for AI, I think it's largely real. And to be honest, it's really hard for me to look at AI as anything other than just a massive jobs killer. It is, yes, there are some things that AI will probably be challenged to do for a good long time, but already what it is able to do is nothing short of staggering. And you have to remember that AI gets better at an exponential rate. So as smart as it has gotten up until now, in the next cycle, it'll get even smarter than that entire magnitude, right? Which means eventually, and probably in the not too distant future, it will get smarter than we can as humans comprehend.
Yep.
And right now, Grok 5, I think it is. No, maybe even Grok 4, but maybe it's Grok 5. They do all sorts of testing on it, and it is as smart as a PhD in every single discipline. So they say, okay, on a single discipline, you might be able to find a few number of humans who know as much as Grok does about that single discipline, but there's no human that knows as much as Grok does across all disciplines, right? And that's right now. So imagine if you had an employee who was as smart as a PhD across every single subject matter that there was, right? That is extremely valuable. And remember, this is an employee, doesn't cost you anything, doesn't take vacations, doesn't get sick, doesn't have any HR issues, right? Doesn't sleep, right? And so what's also really interesting about AI, and I'm no AI expert, is they have trained these large language models on the content that's been generated by the human race. And they've gotten to the point where they're kind of run out of content. They've kind of put all the human content that exists into these models. And so going forward to learn, these models are going to start learning on content that AI is generating itself, right? Which is, again, something that's even hard for us to wrap our brains around. But it just means that these things are going to have vastly more data as time goes on that they're learning from that we don't even have in our own collective knowledge. So these things are going to get extremely capable. And already, we're seeing examples where, companies have just stopped hiring, or to our earlier conversation, they've actually been selectively firing certain groups. Like I said, I think we're at the point right now where the technology is still so new and still being so proven that companies really aren't firing that many people yet and replacing them with AI, that they are they are installing the AI, testing it, and when they get to the point where the AI convinces them, yeah, this is ready for prime time, that's when you're going to really start seeing the layoffs in waves. So I do believe that this is something that's going to be a really big social challenge for us, which is we're going to displace millions and millions of workers that we literally kind of just don't need anymore. And it's not going to be like past technological transitions where, okay, we've delivered mechanized solutions to agriculture, so all those farm hands could now go work in the new assembly lines manufacturing cars, right? Where there were jobs still in another industry to go to. I think we're going to end up in a period of time where there's just going to be really nowhere for these people to go. That's my big fear. And I don't see, nobody's convinced me that that's not going to happen yet. Now, the AI guys will say two things. Well, AI is going to create a whole bunch of jobs that just don't exist yet. Maybe, but I don't see any examples of that yet.
Right, me neither.
So until I see it, I'm very distrustful of it.
That's why they're proposing that there needs to be universal basic income.
Thank you.
Because if it wasn't for that, then nobody would have a way to make any money. And the way that the AI guys are proposing it is that it would be some sort of profit sharing model, which I find very skeptical and hard to believe that these guys are going to part with their billions in order to give everybody a share of that money to live off of. But I don't know, what's your take on that?
Well, so I'm, again, hugely distrustful of this for two reasons, three reasons actually. One is they say, well, this is going to be great for society because people aren't going to need to work. You'll be able to be your best self. You'll be able to learn languages and sciences and how to do great art and whatever, right? That's not how people roll. When people have free time, and we've seen this through the studies that they've done when testing out things like universal basic income, is people just get super lazy. I mean, we're lazy by evolutionary wiring, right? You know, our evolutionary wiring is, you know, hunter-gatherers is expend the fewest amount of calories to be able to still survive, right? So, you know, we've given everybody all the information of the world already for free in a device like this. And what do? You know, we do OnlyFans and watch cat videos, right? You know, we do not become our highest versions of ourselves. So one, that premise, I don't see evidence that that's what we're going to end up doing culturally. Secondly, economically, you know, we just went through this example, right? Where we gave people, we shoved trillions of money directly into the global economy. What happened? Prices went up.
Yep.
Right? So you give everybody universal basic income. Well, what's going to happen is the price of everything that those people spend their money on is going to immediately shoot up in price, such that by the time your next UBI check arrives, it's not going to buy the things that you need. Right? It's not going to be able to afford the things that you need because the prices will have run away from you.
Right. That's one of my arguments against the universal basic income as well, because if universal basic income is based on tax dollars and you don't have anybody contributing to those tax dollars, well, how are you going to even afford the universal basic income?
Right. Well, and your point too, that people are saying, well, you know, we'll take it from the profits of these companies that are implementing AI. But what you forget is that, you know, in a capitalist society, there's competition. And so in theory, over time, these fat profit margins that AI is enabling by pushing expensive humans out, once it starts being just AIs competing with other AIs, they're going to start competing away the profits, right? So there'll just be much less profit to tax there going forward in the end.
Right.
Right.
You're going to be shrinking down to almost nothing in the end.
Right. And to my earlier point, even if there were taxes to take, you give that money to people, it's like a sugar rush. Yeah, the first cycle they get those checks, yeah, they can go buy stuff with it. The second cycle they get the checks, prices are going to have adjusted so high, those checks aren't going to buy anything.
Great point. So I guess in summary then, one of the last questions I have for you here from Jeff is, Adam, in your view, is there a realistic path toward sustained economic recovery in the foreseeable future?
Yes, I think is the shorthand. And that it's probably for threefold. Like I said, I think that the economy will likely be challenged in the near term, and maybe we dip into recession. And first off, folks, while nobody likes going through recessions are healthy. You need them to get rid of, it's the creative destruction that gets rid of malinvestment and whatnot, right? So But I do think in the short term, we will have at least some healthy creative destruction. And, just as there's a down business cycle, there's an up business cycle. So at some point, we'll start going back to an up business cycle. Now, I think that up business cycle is going to be helped by two things, one of which is AI. I do think that AI has good potential to unleash a big sustained productivity boom in corporate America, not dissimilar to how the internet did enable that over much of the past 20 years. Now, that might come at the expense of jobs, as I talked about earlier. So there's going to be some pluses and minuses in there. But I think if you're able to hold on to your job, or get yourself reemployed, either by learning how to use AI or transitioning into one of these other fields that I mentioned earlier that we're going to need, that AI can't do much about in the near term, like getting on board the whole drill baby drill type movement. So anyways, I think AI is going to help. And then third, which I've mentioned, with the new administration focusing on unleashing dramatic investment inside America, building factories, restoring manufacturing jobs, rebuilding our electrical grid, getting out there and drilling for, obtaining or increasing our overall energy production, beginning to go after critical minerals that we let the rest of the world go after and that are now a strategic priority for us, like rare earths, things like that, copper. So the big beautiful bill has a lot of that in it, plus a lot of deregulation, plus some tax relief. And I think the administration, if given its druthers, would like to provide some additional tax relief in the future. I think all those things will be stimulative to the economy. As we said earlier, I don't think we're going to see a tremendous impact from those things, say in the next 6 months, but I would say starting about a year from now, I think, unless there's some big monkey wrench that gets thrown into things, I have a hard time seeing we don't start seeing some nice tailwinds to the economy because of that.
Yeah, and like you said earlier, it might fix some things in the short term, but in the end, it all kind of kicks the can down the road because we're going to have that increased debt ceiling to guarantee our national debt's going to go up in the end. And it's also guaranteed that taxes are going to go up in the future with the one big beautiful bill. So yeah, it's just kind of like, a little bit of temporary relief now, but later on we're going to have more problems. We're going to have to figure out how to deal with them.
So that's very true. I think the only other thing I'd add, just for perspective, is while that sounds pretty negative and for good reason, I would rather be, if I had to pick a country for the next 10 years, I'd rather be America than almost any other country there.
That I cannot dispute.
Yeah, in other words, it's not like there are many other countries that are doing this way better than we are.
That's
or,
right.
Or have the advantages that we do. And I think that's something, whether you like them or not, I think that's something that Trump has realized, where he has said, look, America's got a lot of advantages, fair and unfair, and they're not being used, they're not being exploited as much as they could be. And he has made it a real priority to say, I'm going to exploit them for America going forward. And, a lot of this stuff might not feel very nice to the rest of the world. And honestly, it might not be nice to the rest of the world, but America can do it because America can get away with doing it. And
that's right.
So I do want to say that as much as we have our challenges, I think we're better off than almost every other country. Maybe like a Norway, maybe that might be, or UAE or something like that, where you just have a ridiculous national energy surfeit that, small population and a lot of energy revenues rolling in. Maybe those countries might fare a little bit better on a relative basis, but there are very few countries that are going to fare as well on average, I think, as America.
Couldn't agree more with that. Well, thanks, Adam, for joining me again today. I really appreciate you doing this. Anybody out there watching, tell them where they can find you.
Thanks, folks. And first, Michael, let me say this is always an interview I look forward to doing every year. Thanks so much for coming up here this time. I always get such great feedback and great reception from your audience. So a huge thanks to all of you who are watching here. If you do want to come over to my channel and watch some of the macro interviews that I do about 5 a week, interviewing economists, analysts, top investors about the markets and what's happening in the economy. If you like the type of discussion that Michael and I have been having here, come check me out at thoughtfulmoney.com. And there you can, watch all the recent interviews that we've done. And if you are looking for, help in terms of figuring out how to navigate this world ahead of us, navigate your financial wealth through this world, particularly if you'd like to get a little bit of professional help in that. There are financial advisors that Thoughtful Money can connect you with at no cost, where you can have a free consultation, tell them your story. They'll tell you what they think you should do. There's no cost to that conversation. There's no commitment to having to work with those guys. It's just a free service to help as many people as possible. So if that's something that interests you, there's a short form there at thoughtfulmoney.com you can fill out for that. But really, I'd just love to have you come and watch some of the videos.
Excellent. Well, make sure to have a link for all that down in the description below so you guys can check it out. And if you enjoyed this video, make sure you are subscribed to this channel. And if you don't want to wait for my next one to come out, check out this one on the screen right over here, and I'll see you in the next one.